A HMRC officer asks you to show the invoice behind a purchase you made 4 years ago. Can you find it in 10 minutes? That single question is why bookkeeping exists. Welcome to ActioFin. This is the first episode of our general accounting series. Built around one real business, a joinery workshop in Sheffield called Brindley Joinery. Over 10 episodes we will follow its books from the very first entry to the finished accounts filed at company's house. Today we start with the question nobody asks until it is too late. Why do we actually have to keep books at all? Here is our plan. First, the legal duty behind bookkeeping, and what the law actually demands of a UK company. Then, who reads your accounts, because different readers want different things. We look at source documents, the paper and digital trail every number in your books must trace back to. We cover retention, how long you must keep everything and why. We meet Brindley Joinery, the business we will follow all series. And we close with what to remember. Start with the law, because bookkeeping in the UK is not a matter of taste. Section 386 of the Companies Act 2006 requires every company to keep what it calls adequate accounting records. That phrase has a precise meaning. Your records must show and explain the company's transactions, disclose the financial position with reasonable accuracy at any time, and let the directors prepare accounts that comply with the Act. Notice the phrase at any time. It is not enough to reconstruct the year at year end. The law expects you to know where you stand today, this week, this month. Here is a detail that surprises many first-time directors. The duty to keep adequate accounting records does not stop at the company, it lands personally on every director. Section 387 of the Companies Act makes an officer who knowingly allows the company to fail in this duty liable to a fine. And in genuinely serious or willful cases, imprisonment. The corporate veil, the legal separation that normally protects a director's personal assets from company debts, offers no shelter here. For a small business like Brindley Joinery, with a single owner director, that means the books are not simply an administrative task delegated to the bookkeeper. They are a legal obligation the director himself ultimately answers for. This is not only a company rule. If you are a sole trader or in a partnership, HMRC requires you to keep records that support your self-assessment tax return. Every sale, every expense, every figure you claim as a deduction. The legal wording differs slightly from the Companies Act, but the spirit is identical. If HMRC asks how you arrived at a number on your return, you must be able to show them, with evidence, not with a good story. Brindley Joinery happens to be a limited company, so Section 386 applies directly. But the underlying discipline is the same whatever structure you trade under. Your books serve several audiences at once, and each one asks a different question. The owner or directors want to know whether the business is healthy enough to afford the next decision. HMRC wants the correct tax paid, on corporation tax, VAT and payroll. Companies House wants statutory accounts filed on time, full stop. A bank wants reassurance the business can service a loan. Suppliers, before they extend credit, want to know they will actually get paid. One set of books, kept properly, answers every one of those questions without extra work. Kept badly, it answers none of them convincingly. One thing worth understanding early, filed accounts at Companies House are not confidential. Once submitted, they join a public register that anyone can search and download for free, in minutes, from a phone. A supplier deciding whether to extend Brindley 30-day credit terms routinely checks this register first. So does a competitor sizing up the workshop, or occasionally even a large customer before signing a big contract. This public visibility is another reason accuracy and timeliness matter well beyond simple legal compliance. Sloppy or persistently late accounts on a public register send a signal about the business that no amount of good sales talk can undo. Here is a principle we will repeat all series: a book entry is only as good as the source document behind it. When Brindley Joinery sells a fitted staircase, the source is the sales invoice. When it buys timber, the source is the supplier's bill. When wages go out, the source is the payroll record. When cash moves, the source is the bank statement. Bookkeeping is the disciplined process of turning these documents into organized figures. Lose the document and, strictly speaking, you have lost the proof behind the number, even if the number itself still sits in your software. It helps to know the main categories of source document and exactly what each one proves. A sales invoice proves a sale happened, and at what price. A purchase invoice or receipt proves a cost was genuinely incurred, and names who it was paid to. A bank statement proves cash actually moved, independent of what anyone claims. A payroll record proves exactly what staff were paid and what was deducted for tax and national insurance. An assigned contract or order proves the terms both parties agreed before any money changed hands, which matters enormously if a dispute ever arises later. One habit ties everything together: bank reconciliation. This is simply the process of matching every entry recorded in your books against what the bank statement actually shows happened. Done weekly, it catches a duplicated invoice, a payment recorded twice, or a transaction that never made it into the books at all, while the mistake is still small and easy to trace. Left until year end, the same errors have compounded for months, and untangling them costs far more time and, usually, far more in accountant fees than a 5-minute weekly check would ever have cost. A common worry is whether a business must physically hoard paper for years. HMRC guidance is reassuring here: digital copies of most original documents are acceptable, provided they are a true, clear, and complete copy of the original. This is exactly why Brindley's bookkeeper photographs every receipt on her phone the moment it lands in her hand, before it can be lost or faded. And the accounting software files it permanently against the correct entry. A handful of documents, notably some VAT records and certain company statutory registers, have specific rules worth checking with an accountant, but for the vast majority of day-to-day paperwork, a clear photo genuinely is enough. The flow always runs the same way. A transaction happens, Brindley sells a bespoke wardrobe. A source document is created, the sales invoice, numbered and dated. It is recorded in the books, whether that is a manual day book or, more likely today, cloud accounting software. And finally it is filed and retained, ready to be pulled up years later if anyone ever asks. Skip a step and the chain breaks. And a broken chain is exactly what an HMRC inquiry or an auditor will find first. In practice, very few UK businesses still run a paper ledger. Brindley Joinery, like most small companies today, uses cloud accounting software. When an invoice comes in for a delivery of oak boards, the office manager photographs it on her phone. The software reads the amount and supplier automatically, and the image is attached permanently to that entry. This matters for the law too, because making tax digital, which we will cover properly in episode 5, increasingly expects digital records as the norm rather than the exception. The paper habit has not disappeared, it has simply moved onto a screen. A question every business owner eventually asks: how long must I keep all this? For a limited company, the general rule under the Companies Act and HMRC guidance is 6 years from the end of the financial year the records relate to. If HMRC opens an inquiry into a return, Or if a transaction straddles more than one accounting period, the clock can run longer. Sole traders face a similar 6-year expectation for self-assessment records. 6 years feels like a long time until the day an old invoice is the only thing standing between you and a penalty. It is worth understanding the far end of the consequences, even though it rarely gets there for a business paying reasonable attention. Beyond financial penalties, Companies House can begin compulsory strike-off proceedings against a company that persistently fails to file its accounts or confirmation statement. Left unresolved, the company is dissolved and its assets can even pass to the Crown. This is genuinely rare for a business actively trading and communicating with its accountant. But it illustrates how seriously the filing regime is enforced. And why a missed deadline should always be treated as urgent rather than something to quietly hope will resolve itself. A few numbers to fix the point. 6 years is the standard retention window. HMRC can impose a penalty of up to £3,000 for failing to keep adequate records per tax year, even before it looks at whether tax was underpaid. A private limited company must file its accounts with Companies House within 9 months of its year end. And accountants routinely tell us that reconstructing a lost year of records, when a business has been careless, costs upwards of £1,500 in fees alone, often more. Good bookkeeping is cheap. Bad bookkeeping is expensive later when you least expect the bill. Meet the business we will follow for the rest of this series. Brindley Joinery Ltd is a joinery workshop in Sheffield with 6 staff, making bespoke kitchens, staircases, and fitted furniture for homeowners and small building firms. Turnover sits around £680,000 a year. It is family-run, incorporated 4 years ago, and it has grown steadily every year since. The one thing that has not grown is the owner's confidence in his own numbers. He knows roughly whether the bank balance looks healthy, but he has never really trusted what his year-end accounts tell him. That is exactly the gap this series closes, episode by episode. Brindley's bookkeeping today is a mixed picture, and it is a common one. Sales invoices are raised properly through the accounting software because customers expect a proper invoice before they pay. But supplier receipts for small purchases, timber offcuts, hardware, fuel, often go missing in a van door pocket. Mileage for the owner's van is estimated from memory rather than logged. And nobody reconciles the bank account against the books until the accountant chases everyone in January, under deadline pressure. None of this is dishonest. It is simply undisciplined, and undisciplined books cost money in accountant time, missed deductions, and sleepless nights before the tax deadline. It is worth putting a rough number on the current cost of Brindley's undisciplined habits. Because vague guilt rarely changes behavior, but a real figure does. Brindley's accountant estimates the extra time spent chasing missing receipts and untangling the bank each January adds roughly £900 a year to the accountancy bill, on top of the base fee. Beyond that, around £400 of VAT that could legitimately have been reclaimed on van fuel and small hardware purchases is simply lost every year, because the receipts proving those purchases were never kept. Together that is over £1,000 a year, essentially the cost of doing nothing differently. The fix for most of this is not expensive software or a finance degree, it is a short weekly habit. Photograph every receipt the day it lands, before it disappears into a pocket or a van door. Log mileage immediately after a trip, not from memory weeks later. Reconcile the bank once a week, not once a year. File the VAT return the moment it is due, rather than at the last possible hour. And ask the accountant a question the same month it arises, instead of saving up a list of confusions for the January scramble. None of this takes more than a few minutes a week, consistently applied. Here is the real prize, beyond simply staying legal. Once Brindley's records are accurate and kept current, the owner can answer questions that matter to running the business. Can I afford to take on a 7th member of staff? Is the staircase work actually more profitable than kitchen fitting? Do I have enough cash to buy that new saw outright? Right now those questions get answered by gut feel, weeks after the moment has passed. Good bookkeeping turns the ledger from a compliance chore into a genuine decision tool. And that is the thread running through every episode that follows. 3 habits that cause real damage. First, the show barks approach, sorting a whole year of receipts in one panic January weekend, which guarantees missing evidence and missed deductions. Second, mixing personal and business spending, paying for business fuel on a personal card, which blurs the very trail that HMRC and lenders both need to see clean. Third, trusting memory over paper, writing up a mileage log 6 months after the trips happened, which rarely survives serious scrutiny. Every one of these is easy to avoid with a 5-minute weekly habit, and expensive to fix after the fact. Let us bring it together. The Companies Act, Section 386, demands records that explain your transactions at any time, not just at year-end, and Section 387 makes that duty personal to every director, not just the company. Several very different readers, from the tax office to your bank, depend on that same set of books, and once filed they sit on a public register anyone can check. Every single entry must trace back to a genuine source document, invoice, receipt, or bank line. And everything must be kept for 6 years, longer if HMRC opens an inquiry. One relationship worth clarifying before we move on, because Brindley's owner used to assume it was all the same job. A bookkeeper handles the day-to-day recording of transactions, exactly the discipline this episode has described. An accountant, often but not always a qualified chartered or certified accountant, reviews that work, applies the year-end adjustments we cover in later episodes, and prepares and files the statutory accounts. But hiring both does not transfer the legal responsibility away from the director. Section 386 and Section 387 still point at the owner personally, whatever team he employs to help him meet the duty. In the next episode we open Brindley Joinery's balance sheet and answer the question every owner should be able to answer instantly. What do we own, what do we owe, and what is actually ours? You will find the full course, with calculators and practice cases, on ActioFin.com. See you in episode 2.